Thank you for joining iMeet. When you hear the tone, you will be the 29th person to join the meeting. It is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. Sorry I missed you guys the last couple of weeks. As you know, after a Monday holiday, I really don't have anything new to say except what was in the Friday market letter. So that's why we haven't had one the last couple of weeks. But we'll try to catch up here now, and we've got a couple of things to go over. First off, we want to congratulate Alabama on their good game last night. Us Georgians down here, I had a long night, but great game as usual, so I can't complain too much. It was a heck of a game. Anyway, we're going to get started here, go over the major averages, go over all the different sectors where we want to be right now. If you're new to this webinar, I usually talk about 20 or 25 minutes, but it usually goes a little bit longer than that. What we have to do after that is we open it up to questions about individual stocks, targets, what we've been talking about, or sectors, or anything about the market that's bothering you that you'd like to see if maybe I can weigh in on and give you a little bit of help. Okay, so let's get started right now. Since we haven't been here for a couple of weeks, I want to just, the market just goes up almost every day. So what I want to start out here, we'll start out with the Dow, and then we're going to look at the different sectors, see what's strong, what's weak. Okay, as you can see over here, we're just walking up this channel, just going from one end to the other. We're only pulling back about halfway into the channel right in this area. It looks like we're getting ready to break out above it again. We're up another 117 points, all new records across the board again, 25.4. I don't have a target for you this week, but I'm sure it's going to keep going higher. Now, what's different and what's changed over this area back in here? Besides the tax cuts, and now we're getting Trump talking about the infrastructure spending, that type of thing. But this repatriation of money coming back from overseas is going to bring like $2 to $2.5 trillion or so back into the market. It's almost like another quantitative easing. And that's why this market can, even though it goes up every day, why it can continue to go up a little bit from here. This thing isn't over or yet by any means. Now, we are overbought, and we'll go over some of those indicators that are showing how overbought it is. But just because a market's overbought is not a reason to sell. Stocks and markets can stay overbought for a long time, and even when they get overbought, it doesn't mean they're going to pull back or correct to get back in line. It just means maybe they go sideways for a little bit and work off that overbought condition. All right, right now the CTI is a bullish +8. We rolled that over last week. I'm going to talk about the CTI because it wasn't a very good year for that last year. Although, when we're talking about it, I hope you'll get a little bit better understanding of that. The momentum index is a neutral -3. The reason it's neutral is because the Dow Jones is outperforming just about every other index right now except maybe the transports. You'd like to see a little bit better, a broader mix in leadership, but the market's still strong and has lots of momentum. But that's why the reading is neutral on that. If we were getting more, if the Russell 2000, maybe NASDAQ was outperforming the Dow, that would go up to a positive, +3 or +4, that type of thing. So we're pretty much in a melt up with just about every sector except for the defensive sectors, and that includes the utilities, the REITs. Consumer staples are basically flat over the last couple of weeks or so. We have a sentiment index that is a -1. We still have a little bit of excess bullishness. The percent of bullish advisors has been in the danger zone for 13 weeks now. I don't know. That means they're more than 60% of professionals are bullish. I don't know if I've ever seen it where it's been where everybody's been that bullish for that long. Also last week, in the letter we talked about the AAII survey. That's the American Association of Individual Investors. We're at 59.8% of that. That's a 7-year high. So again, even the mom and pops, you and I are getting a little bit too bullish, and that's a contrarian indicator. But at this stage, as long as this thing keeps going up, it's not something that we're going to take as a sell signal. Now, maybe if it jumps up to 75% or something like that, we get a little bit more nervous. But for right now, we're fine with all the different indicators and all. Okay, over here, this is the NYSE AD line, which we usually look at every week. This is, I consider, a leading indicator of market direction. You can see this thing just keeps on making new highs every single day. The breadth today is again extremely bullish. We've got, I take that back. I thought it would be. We're up 120 points, but you have more declining issues than advancing issues in both the NYSE and the NASDAQ, which is a little bit strange. And volume's about even. That's something you usually don't see when this thing's up 120 points. But anyway, this is just confirming the move higher, that we still have a ways to go. Generally, before the market pulls back or has a correction, this thing will usually top out maybe 6 weeks or so, and then the market will start to pull out. When this thing starts to come down like this, that's when you start to get a little antsy if the market's making new highs. But right now, as long as this is going higher, that just means good participation in this move. All right, now we have the new 52-week highs versus new lows. Last time we were here, we were talking about over here that this contraction wasn't good. We wanted to see this start to work its way back up and expand these numbers. That just shows you how many more stocks are making new highs as we're rolling here. This expansion is good. We're up around 250 again today. So that, again, is a confirming indicator or chart that the market still has a ways to go higher. All right, this is the S&P 500. Again, we have this channel going up. This is called a throw over. We are a little bit over. Again, we're overbought. And just to let you know how overbought we are, the short-term S&P, short-term oscillator is hitting 5 again. Historically, when that happens, you'll see the market pull back a little bit, or perhaps trade sideways to work off that condition. The S&P 500 also, here's the 200-day moving average down here. We are now, as of close yesterday, about 10.2% above that moving average, which is the last time we were that far away from the 200-day moving average was back in August of 2013, and we had a pretty healthy pullback, up about a 5% pullback then. The S&P was down like 11 in the next 13 days and pulled back about 750 points. Again, just because you're overbought, though, it does not mean that we're going to have a pullback in the next couple of days. But don't be surprised if it does come back a little bit inside this channel at least. Maybe back to the 2,700 area, something like that. The pivot point down here is 2650. But I don't even think we would test that in here and pull back to this level here. I think we're, it's still too much of too strong a momentum. All the indicators down here are confirming that we're making, going to make new highs. That they're all bullish. Even the advanced decline lines are still going up. So nothing overbought. If we pull back 2-3%, throw more money in. Okay, here's the NASDAQ. Again, we have another throw over here on this channel. It needs to come back in this area. I don't think you'll even, even if we have something that happens geopolitically, I would be surprised if he would come back down to the 50-day moving average at this stage. Again, we're making a new high. The 14-day RSI is confirming that. MACD is confirming that. We're above. As long as we stay above that 80 range, that just confirms that we're in a strong trend. Here's the NASDAQ AD line, which we looked at this over here. We wanted to see this thing break out above these highs here if we were going to continue higher. Well, we're getting that right now, and we're also getting confirmation that the new 52-week highs. Again, this is expanding. That's what you want to see. This shows good new participation from different stocks, new leadership. In other words, that we're seeing. We still have the leadership from the FANG stocks, but as long as this thing keeps moving up in here, that means we're getting more and more stocks that are joining those up there at the new highs also. So, one over here. This is the Russell. This is the only chart really on the major indexes that is not outperforming really. It's underperformed through here, which is a little bit surprising. We came down here, tested the 50-day moving average. The reason this is a little bit surprising is because the small caps are one of the biggest benefactors of tax cuts. I think what the problem is is, we had this rising wedge, which we break through, there would be a little bit of trouble, couldn't get another test of the 50. But these indicators are showing some negative divergence. I think what the problem is with all the multinationals and stuff and the repatriation of money that's coming in, that the attention has gone to that group, and this group, they'll benefit from tax cuts, but that's still a ways off, if that makes sense to you. I mean, the market's forward-looking, but all this that we're talking about going from 20 or 30% tax rate down to 21 or whatever, the smaller caps have not had that benefit yet. They will, and I think that this group will start to pick up. And once you see this thing start to break out in here, that it will outperform the other indexes. Maybe we'll start getting into February or March as the first quarter starts to come to a close. So we'll keep an eye on that. But I think this will turn around, even though there's some negative divergence in that right now. Here's the transports. They've from this area here, we're up almost like 10% again. It's outperforming the Dow in here. You're seeing the accumulation in that, confirmation of the 14-day, overbought as usual. The reason this is showing negative divergence is because of this pullback in here. It was a pretty healthy pullback, like 6-7%. And this is actually when the CTI was negative over here, but we didn't have any pullback, obviously, in the broader market. So these will also go high. The transports go making out new highs with the Dow. Also is supportive of part of the Dow buy theory, and that's calling for higher rates or higher prices and everything. Also, industrials make the goods. Transports are going to move them. Here's the Philadelphia Semiconductor Index. I brought this up for two reasons. We had this little bit of a rotation we talked about out of some of the tech stocks, but it just came down here to the 50, traded around here, got this trend line, bounced off of that. Now, we do have the workings of a double top in here, which we'll keep an eye on. I think once this thing breaks out to a new high, and you have some negative divergence here, you're up and back above 80, which is strong. But if the next day that we see this thing popping up, that'll break that pattern of the double top, which will be good. Now, if we come back here, we start to work our way lower and lower. That'd be a little bit of a concern because the semiconductors and technology have really kind of led this market for the last year. So we want to make sure that we don't get stuck here in a double top. And if we come down here and start to, especially if we would take out this low, we have a double top, and then we start having a lower low, that's going to be a real red flag for us, and we'll catch that, and we'll start to lighten up at that point. Okay. Last thing over here. Before we jump to the different sectors, we'll talk about what's been leading the group. This is over the last week, including today. And as you can see how broad-based this thing is, everything's up 2.5% or higher, except for the interest-sensitive groups. The REITs and the utilities, the consumer staples to a degree. We talked about the utilities several weeks ago, how they were, rising rates are going to hurt that group. Also, the fires out in California really gave them a double whammy because they're not going to be able to, their revenues and everything are going to be down from not being able to bill out there. But we have materials, which we've, this is the rotation of some of the commodity stocks. Here's the industrials, a lot of the multinationals, the Boeings and all that. We'll be bringing the money back. Here's our tech stock. Even with that rotation, the technology sector is still up, was still one of the leaders. That's because it's not all just semiconductors in there. We got the networking stocks, we have the software, everything else. Financials benefit from the higher rates. The deregulation is also helping that. Energy, we have the oil stocks, which we've concentrated on oil stocks for quite a while. We're going to go into that today because we actually have hit our upside target, but we may bump that up a little bit. That $62 a barrel was kind of where I thought maybe we would start to lighten up on the oil stocks. Maybe not quite yet. And here's the healthcare, which includes the biotech. We're seeing a nice 2.5% rise in that, so that looks good. Here's our worst performing sectors. Utilities were down another 1.67%. They're down almost 7% now in a couple weeks. REITs were down another 1.5% in here. We're going to look at the sectors one by one right now. Next week, we're going to get more into the individual stocks, but I want to look at the sectors right now to see where we are since we haven't been here for a couple weeks. All right, this is the utilities. We'll look at the bad ones first. As you can see, this I put the Fibonacci retracements in here. This is a it's what, a 1-year chart or 9 months maybe. And you can see where this has come down here. It's here's the 50% retracement level from this move back here in last May to where we had a new high here. Here's a 62.8 retracement of this whole move up. Once you break that, it's a pretty good bet that you're going to retrace this whole amount. So I think we still have probably another 4. I think we probably have another 3 or 4% lower to go on the utilities. I wouldn't be. They're oversold, as you can see over this group. But this, as long as this thing's staying under this 20 level, that means that the trend is pretty strong, and we want to. You're not. You're going to get a couple little bounces over here once in a while just because it's oversold, just like you have a little pullback or after a gap up or whatever. But I think you'll see a little bit more downside in this. Like I said, probably another 3 or 4%. You can also see down here where the when we see these breaks of these trend lines on these AD lines and stuff. That's not you and I. That's the institutions. They're pretty much dumping it. And I could see again the utilities come down here to XLU come down to about 50. That would be a complete retracement from its move higher in May. All right, here's the REITs. You can see we were walking up this way, and then we're having kind of lower highs and lower lows here. You're also getting some confirmation that this may go a little bit lower. Also, we're below the 50, below the 100. 200-day level would be this. Now, one thing I want to point out is that all REITs aren't created equal. And what I mean by that, some REITs are put together that they're just trying to get income-producing properties, and so they can pay out good dividends. And they get more people coming in there to put their money in. They get more money. They buy more income-producing properties. Maybe like storage places, things like that. And the investors that go in there say, okay, I want to get my 6-7%. That's good. Well, they become less attractive, those kind of REITs, once rates get a little higher. Now, however, some of these REITs, when I say they're not all created equal, some REITs are put together for growth. They're buying properties that are undervalued. They're buying in boom towns, that type of thing. They're buying in maybe hospitals or something like that. Something that has good growth potential. As inflation starts to go higher, property values will move higher also, and those properties, those REITs, will continue to make money and grow. So if you're looking at you want to just to diversify a little bit, maybe you find a good REIT that is looking to buy growth potential properties that are maybe paying 3% or 4%. So you're not buying it just for the dividend. 3-4% would be healthy, but you're expecting these properties, especially once inflation kicks in, to go up in value, and those are the REITs that you would have some interest in now just for diversification. The next one is consumer staples. We're kind of in a trading range over here. This can work its way higher. You can see the little bit of selling and pressure over here while it's going sideways, starting to pick up a little bit. The trend is still up. It's still strong. Some negative divergence here in the 14-day RSI. But I think with the XLP and the consumer staples, I think you're going to underperform the broader market in this. Now, some of the multinationals like the Procter & Gamble's and some of those, they'll benefit from repatriation of money. They'll be buying shares back, and they'll perhaps raise their dividend, that type of thing. But if the market would go up 15%, I think you would see this group maybe go up 9 to 10%. So if you want want a little bit higher dividends, and you'll sacrifice some growth for that, these will be fine. We'll see this thing, maybe see if it breaks out to a new high in here. Otherwise, I think that if you're a younger person, you're looking more for the growth, you probably steer clear of these a little bit. Now, I wouldn't be an aggressive buyer of those. All right, now let's look at the good groups. The last couple of weeks, right before our last webinar, in fact, I was looking at our notes. We talked about Trump bringing up the infrastructure spending that he wants to do. We talked about the materials. We talked about getting involved in the steel stocks, copper stocks, construction stocks, all those things. All of those groups have really outperformed. And you can see just over here is where we were talking about it, and we broke out. We've had a great move over the last couple of weeks. And I still think it's overbought, but I still think we have further to go for the rest of the year. You can see the turnaround over in here where we were going sideways. Once they started bringing up the infrastructure spending and that, we got this big pop up here, and I think that'll continue. Like I say, we're overbought, but any type of pullback, I would be putting money in some of those stocks. They've had a heck of a run here the last couple of weeks, and I hope you were buying them over here when we talked about them. Let me see here. Okay, we still at steel, building, construction, home building, copper. Here's one here that I brought up because right over here is when we started talking about going into commodities, that with the rotation was going into that. We had like 16, 17 days where copper went up every single day. They had a bigger imports in China. That helped all this. You're having a little bit of a pullback in here, but that's all this is. This is just a little, you have 17, 18 days where you go up every day. You can have a little bit of a correction in here, but I would buy some of these copper stocks if they pull back to this area. Here, the pivot down here is around 319, but just look at some of the stocks which we can look at next week. We're going to look at more individual stocks on that area. Here is oil. This is going back 6 months. Again, back in here, back in August and September, this area over here, we changed our mind on oil. We got bullish on it. I think we've done pretty well. I had a $60 target. Today we actually have broken through 62 now, and I think 62 is about where I thought we would top out. But we'll look at another chart in here. I'm just going to show you that I think possibly we could get up to a $70 range on oil. We'll have to see that. You can see the accumulation going in here. We're up above this 80 on the 30-day. The 14 days confirming this move higher in oil. This is I brought this up. This is a 5-year in oil. You can see over here from this last, the summer of 2013 down to this area here at the beginning of 16. We've retraced now about 50% of, well, no, we haven't either. We're at the 38.2% area. That if we break through that, and this is where the next target would go. If we go through this area right here, I think that oil has a chance to get to $70. That would be where I think is about as high as we're going to get, 70, maybe $71. If we see that over the next, say, 2-3 months, the reason this is going to go up, several reasons. We still have that global economic growth in sync. We also are having some problems over there, with Iran. They were doing some saber rattling today. That caused oil to jump up, $1 today. You've had some burst pipelines that didn't help. But the Mideast concerns are making this go up higher. And if things get a little bit rowdier over there or whatever, I think we could see a pop that maybe could take us to that 70, 72 area. And at that stage, as soon as we start to pull back, I would go. The reason I don't see it going back up to 100, obviously, is because the frackers here in the United States aren't going to just sit on the sidelines and leave their oil wells down and not producing. So, but again, if things pick up in the Middle East, we could see a run up to that $70 range, where I think that would be about as high as we're going to go. All right, the next sector here, we're going to look at industrials. Again, we're walking up this chart. This is a, let's see, 1, 2, this 5-year chart. Again, just walking up this channel. Nice accumulation all the way up. This is a weekly chart. We're getting confirmation with the 14-day RSI. Overbought like everything else in this market is, but it's still working its way higher. Industrials should continue to lead the market, making new highs. Over here we have technology. Again, even though we had this little bit of we talk about the rotation on semiconductors, you don't see that in the 5-year chart. You have a little bit of sideways motion over here of just some consolidation in that, and now we're breaking out again to new highs in the technology, confirming with all the different indicators. This accumulation just keeps rising up on that. We still have upside in the technology. This is the financial stocks. Again, we had that channel going up here. We came down, tested this for a little bit. Then once rates started to go up, we're moving there. The institutions just continue to buy these. Bank stocks still have a ways to go. This is actually, I want to bring this up. This is actually a 12-year monthly chart on the financials. So as you can see up here where we are now, we have just broken above where we were right before the meltdown with the financial crisis. So to me, with the confirmation of this and still the accumulation, we can go higher now, and the financials are breaking out that we're going to have a new high. Some of these stocks still, like Bank of America, J.P. Morgan, some of the big ones, and even some of the regionals, all the deregulation, they still have a ways to go. You can still buy these things. If you want to buy it, wait for pullbacks, you can do that. But financials are probably going to lead us higher. We have a rate hike expected in March. That'll help the financials again move higher. The only thing we're going to keep our eye on, and we'll do it here, so you're not sideswiped, is we'll keep an eye on the yield curve. When we start to see that, maybe we'll talk a little bit about that next week. We see a flattening of the yield curve or an inverted yield curve. You're going to know about it. We're going to be talking about it, and we're going to be talking about that. What do we want to do here going forward? Because we're probably going into a recession, but that's not in the cards at this stage. Okay, next we have the energy. I brought this up. This is another long-term chart on the energy. This is also a 12-year chart. Now, the last couple of years we've been doing this. Remember we talked about when you have a long-term chart like this and you break a long-term trend line, that's more than just some selling. That means fundamentally something has changed. Okay, at the time we thought, okay, well, you don't know what it is sometimes, but whether there's electric cars coming in like that. You have all these countries that are saying they're going to go completely electric in a couple of years. Then you had oil was coming down and was falling, went from $150 down to $25 or whatever. So those are the things that were going on in here. We stayed out of here. We got in and out a little bit over here. And this back here in September, August is here. We saw another trend line break. It went to the upside. We've now retraced, about 62.8% or whatever, 60.8 of this move down. And if we get through this area up in here on the XLE, which would be somewhere around 77, 78, that means we could probably get a complete retracement of this whole move down, which would put us up here around $80, I guess, on the XLE. And that may mean that what could do that, push that up there, would be if we get oil going back up to $70 a barrel. That would be something that would cause this thing to break out above that. Okay, next a couple more here, and then we're going to open up to the questions. I see we got a bunch of them here, and I don't want to go too long. Just coming back. Okay, here's healthcare. Healthcare, I think, is going to outperform going forward. It's been kind of some consolidation in here. Now we're starting to break out the new highs. I don't really. Some people may say this is a little bit of negative divergence. I don't really see it. You got good accumulation, and what you want to own in here is we talked a little bit about before. This is the biotech IBB biotech ETF. You see it's going up and down in this channel. Good accumulation. You just bounced off the 50 mark on the 30-day stochastic, which means that we get up here and go through 80. We're going to get another rise up here at the top of the channel. You still want to buy the biotechs. They've had a little bit of a pullback here the last week or two. Might be a good chance to pick up a couple of those. And I always recommend buying a couple rather than put it all in one. Try to get something that has, that you get a little bit of a basket on that. So that's it for right now. We have a bunch of questions I'll try to get to right now. If you have anything else you want to add in there, throw it in, and I'll try to share the screen if we can't get them from here. Okay, regarding CTI on the site and last weekly, it is bullish. Did you just say it should be neutral? No. The CTI is bullish now. It's going to stay bullish into the in through March, I believe, or into March. Now, what I was trying to say was, I had somebody send a letter that said this thing doesn't work at all. There were two times when we went to a bearish CTI, which is not saying what the market's doing. The CTI is a forecasting tool that we use, and it's just historically there's times in the business cycle that things will slow down a little bit. And when we were negative, the Dow this year has just kept going higher every day than the S&P. But we did have some pullbacks in the Russell 2000 and the Dow Jones Transportation. So not all the market was in full strength during some of these negative CTIs. But again, that's why you read the weekly market letter, and you also look at the momentum index. The weekly market letter, even though we had a negative CTI, I wasn't saying we need to get out. I've been saying the market's going to work its way higher from here. There were times where you may want to be cautious because we were so overbought. But just because the CTI goes negative, It just means that perhaps the business cycle should slow down. And a -3 isn't much of a slowdown on the CTI. That thing can go down to a -13, -11. That's usually when you're going to see more of a pullback, like we had back in 2016 when we had a couple times where we actually outperformed the broader index S&P by about 12%. So this year we underperformed it, mainly because this thing never took a break the whole time. So that was what I was going to say. CTI is a +8. What do you do if the double tops on stocks occurs? I don't think it's going to. I think you're going to start seeing maybe get a little bit of a pullback. The semis are down 1%, but before you want to sell that, we'll take a look to see if it takes out that lower, makes it lower low. So you have a double top and then a lower low. That may mean that probably the whole market's finally going to get ready for a little bit of a correction. We're so overdue, but any type of thing, I think you're going to look at any kind of pullback. I think you're going to want to buy it. Okay, Linda wants us to look at JJC for copper. Any thoughts on how to play the blockchain craze? I don't. I can hardly have it. I hardly understand it. So I can't do that. Okay, I'm going to share the screen here and look at a couple of these stocks that you have up here. If anybody else has any stocks they want to look at, throw them up there on the question thing in your bottom left-hand corner, and we'll get started on that. We're going to look at JJC and also AT&T. And also next week we're going to talk about CHD. We're also going to talk about the portfolios that we hope to be pulling out. And what I'm going to try to do is give you the stocks on these portfolios going forward for a while. Okay, let's take a look at this now. Can you see the screen chart?
It's loading.
Loading, okay. The portfolios that we have over here, we have about 8 or 9 of them. They were all pretty much up about 30% last year, so we did quite well, and we're going to see if we can get you in on that. Okay, let me make this chart a little bit lower here, smaller time frame. We'll go 1 year, I guess. All right, here's JJC. This is the copper ETF. You can see here's that run here where we had the 17, 18 days straight up. We have a little bit of a pullback. I think I can't get to my drawing tools over here. I was going to see what the half a 50% retracement would bring it back down to here. I don't think you'll go. This is 36.62. I would look to buy this around 36. You have these things down here. You'll get this. You've just worked off your overbought condition, but look at the accumulation. Despite going down, they're still buying these things. When we see these AD lines hop up like this, and we always talk, well, that's not you and I. That's the institutions buying that, and they've been buying that. It's the same way with the materials. So you want to be, the materials have a ways to go, especially with the infrastructure. As long as the housing market's strong, you got to have the copper, and China continues to import more than anticipated. All right, AT&T's been all over the map. Are we in a trading range going back here? A pretty wide trading range from 32 to 38. You can see down here, you're kind of iffy on the accumulation. AT&T probably has some growth. Some of these. There were a lot of merger talks. They were going to buy some, that type of thing to cause it to go back. It pays a great dividend. I don't know how much upside you have in here. I think you can work your way higher, but I wouldn't look for this AT&T to outperform the market. The industry to me is a little bit not quite as strong as some of the other things. I would look more towards the materials rather than AT&T. I'm going to look at CHD. Okay, Church and Dwight, big pullback. You've already come back over the 200-day moving average. You got the other ones moving up. You got a confirmation of this in the momentum of the 14-day RSI. Good accumulation. You had profit taking in that. I think in this thing here, you had 2 nice days. If I'm looking to go into it, well, you might look to see if you can get it down here above the 200 days. Yeah, that's going to hold. But I think this thing probably, since it's already retraced more than 50%, this probably goes, to me, looks like it's going to go retrace this whole amount and get back up here into this $53 range. So I think you're fine on this thing if you're holding it for that. All right, let me see if we got any more down here. Huh. I'm not seeing the IMED thing here. Oh, here we are. Okay, 2 more. Okay, CHD, let's see, ESPR and SAN, okay. And again, next week, I want to say we're going to look at portfolios on this thing and see if we can get you start to build a portfolio using some of the market edge tools and just kind of get you centered a little bit better on how to pick some of these things. All right, here's SAN. This is a bank, I think, is in Spain, Banco Santander, yeah. Okay, we're in a sideways motion on this thing. This thing, from what I remember of it, pays a great dividend. I don't know whether they've cut it or not, but as Europe, all the European ETFs are moving up. I think this is out of Spain, if I'm not mistaken. Maybe Portugal, I'm not sure, but I think you can buy this thing. I think you're going to see it move higher. The dividend, even though a lot of times they get scared, they say it's not safe. I think that they've gone through some hard times, but as rates go up over in Europe, they're already talking about that. This bank could probably go higher. I would say in the past it had gone up to around 11 or 12 or something like that. And like I say the dividend on this thing is great. So that's the fine. All this sideways motion in here, this consolidation, I think you can break out from that. This is up about $1.50, so 6, 7. You maybe get to about 8 on this thing over the short term. Okay, ESPR. Little negative divergence in here on the MACD and also the 14-day RSI. Accumulation is just so-so. My only thing on this thing, if I remember, if I'm correct, some of this sideways action on this is if I'm correct, I can't pull it up right now. Is that I thought they sold prescriptions too, and if that's the case, I'm a little bit lukewarm on those particular stocks because I don't know how this Amazon thing is going to work out on that. So this looks fine. And like I say, you have some negative divergence in here that you want to be careful with. If it if it starts to pull back here and breaks this 62 area, that's the pivot point. You might have some people that you might get a little bit more selling with this negative divergence. I would keep an eye on that. I might wait for it to pull back before I would buy it in here. Okay, that's about it. We've gone about 40 minutes. So I'm going to go ahead and wrap this up. I really do appreciate you taking some time out of your busy day to join me on this. I hope you got something out of it. We will be back on a regular schedule now going forward. And again, next week we're going to talk a little bit about rates, and we're also going to start talking about the portfolios. And depending on your investment style, I think we'll be able to find something that you'll like that you get out of that. So have a good week, and we'll see you next week.